Okay, I know we are not very, only four of you, five with me. Um, People are probably too scared, and a lot of people watch the replay. So today, this is the seventh session, and I'm going to go a bit into the volatility surface. I recommend for those who come for the first time to maybe watch the first sessions. As I mentioned on several occasions, I just go, as I fancy a topic, but it does make sense. I mean, we've done a bit of modeling, Black and Scholes. We've done the vertical skew across a single option chain, so a single expiration. I haven't really touched on the horizontal skew, although I talked about some calendars and also introduced the weighted Vega. So today I thought, well, it would be a good time. And it's also because on my own program, SOAP, for those who know what I'm working on, I'm about to activate the volatility surface. So, and because on the June presentation, I said, well, I am going to be quite open about it. Everything I put in it will be explained, will be described, because if there's something I personally don't like, it's the black boxes. We don't know how to calculate things. So I'm going to show a volatility surface. And for those who don't know what a volatility surface is, it's basically a blend of volatility across several chains. So strike-wise and time-wise. So if we go back to the Black and Scholes equation, from that equation, we can actually derive the volatility behavior according to time and according to strikes. I mean, this is the basic Black and Scholes, from which the call price and the put price can be deduced. And it's a bit of a complicated mathematical concept, but I'm going to show that in my own approach, I'm going to make it simple, because this is still a very much a trader's approach, a practitioner's approach. And even though I read a lot of material, master's thesis, sometimes PhD thesis, and I've got quite a number of books, and I can recommend a few if some of you are interested into the math stuff. I'm still not an academic. I'm not here to design a better model, and I'm not here to actually try and comply with the strict constraints that a quant would have to design a volatility surface in a portfolio situation. For example, there's if you go back to Black and Scholes, and you can even just look at the definition in Wikipedia, one of the constraints is the no arbitrage condition. That personally, and I think most traders don't really care about it. I mean, the market should be liquid enough and large enough to actually eliminate those arbitrage opportunities. So I will take them for granted, so that the vol surface I'm going to build will be what the market is giving us. So if you have any question about Black and Scholes, but what's important is this main equation coming back from geometric Brownian motion and all those things, and things I've described briefly in previous sessions. You can see that it's typically volatility versus time and versus strike or price of the underlying. So because I'm going back a bit, because I had some comments on the Aramir forum or directly or on Slack, or that it's a bit of a chicken and egg situation. Yes, Black and Scholes is a closed equation, which means that you can derive volatility from the options market price, but you can't have both at the same time. So some people said, well, but so how can you work out what the price will be without having the volatility or vice versa. So I know it's something I also went through at the beginning. That yes, it looks a bit puzzling at first, but it's not a problem. And also for those who don't like this way of approaching options, there are other ways to actually price options. That's a session I haven't done, maybe because it's not my major interest. But there is the binomial, or even sometimes a more fancy model called the trinomial model, which is an open equation. It uses loops or recursion to actually figure out the price of an option going through time, and probabilities of the line going up or down, and how it changes the price. It's actually a longer question of options pricing. So I might go into that for those who are interested. I think when you go through a formal training on options, it's something that you go through. I personally don't really like it, but it's one way to look at options pricing. And for those who want to find some references, I think the first binomial model was the Cox-Rubinstein model, and I even believe it's one of the options in OptionView. I used to work on OptionView. I do not have it anymore. I work either on one or my own software. But that just to say that for those who feel uncomfortable with that closed equation, there are other ways to price options, and from that derive volatility. So what is the vol skew? And yeah, here again, so we just look at the vertical skew for reasons that, demand and supply and other things, and the need to hedge. Basically, the price of OTM options are higher, and I mean, I know it used to be a limitation, and some people used to say, well, Black-Scholes doesn't work because it presupposes that volatility is constant and across the whole chain. And when Black-Scholes actually designed that equation in 1973, it was a valid hypothesis, because the vol skew really appeared when the option market really exploded. I mean, thanks to computers, thanks to more participants in the market, and also after the 1987 crash, the demand on hedging increased dramatically. So yes, the vol skew is not a straight line, and we have a skew that is very much dependent on the dynamics of the market. A lot of us are index options traders, the Russell, SPX, or NDX, or sometimes we trade stocks, options on stocks or futures. It's still important to know that the volatility skew is very much dependent on the dynamics of the underlying. And I will always have that concern when, for example, some people ask me, can you do the Rhino on oil or gold or other underlyings? And then I say, wow, be careful. The vol skew is very different. So I'm not saying that we need to study, analyze very, very deeply. And again, I'm going to be using probably the simplest possible model in SOAP, my program, and what I'm going to explain here.
Zur Deutschen Bahn hatte Leitungsfunktionen im Bereich Bildung.
Sorry. Hello?
Sie schon. 2001 wurde sie
Personalleiterin. Somebody has his mic on, and it doesn't even sound English to me. Okay. It's okay. I mean, please unmute if you wish to participate, and you can interrupt me at any time. So because it's a practitioner approach, and also because traders, even quants or fund managers, they like those very quick back of the envelope way of assessing or using the skew. You don't necessarily need to go as deep as I'm going to go. And some people just look at what they call the 90% or the 1910. So basically, they look at what the IV is on a 10% OTM put versus a 10% OTM call, and they work out a quick and dirty skew. That's fine. And as a matter of fact, there are also mathematicians who are trying to get to the best possible model with the fewer possible data points, because it's very much a matter of sampling prices. And if I go back to what I said earlier, from prices you can derive the IV using an algorithm, an extraction or root finding algorithm. And I mentioned last time the Rafson-Newton root finding algorithm, and there are others like Nelder-Mead. So for those who don't want to get into the details or just glance through the last presentation, again, it's a closed equation, and let's just assume that we can get IV from an options price. So the point is to get IV on a number of points, and as I said earlier, it's going to be across strikes in one expiry, and also through time. From generally, there's no need to actually, unless you trade very long options like leaps, and then you will look at volatility very far out. But at the same time, when you are very far out, the vol surface does not have much implications. So generally, if you trade RTT, Rhino, X4, all those trades, you trade within 100 days, 80 days, 80 DT. So the point is to look at how volatility behaves from 0 to so many days. What is important, again, and that's what I wrote here, because I do get the comments from a few people. How does that help me? I mean, what if the skew is high or low? Okay, what do I gain? How can I turn this into practical information? Excuse me. Well, if the skew is high, and that you can really on any platform, you will see that if you need to hedge, and of course, we generally too late. It's a lot of hedging is more reactive than proactive. But for example, now when the market is shooting up and the skew is very steep, at least the short-term skew is very steep, the hedges are cheap. So, but that will be more linked, related to your way of approaching hedging. And for example, the ATM straddles will be cheaper than relative to strangles, all those things. All I'm saying is that the skew, because we generally trade in spreads, put bid spreads, put debit spreads, the skew will affect the pricing. That's quite obvious. At least for it's actually easy to visualize in a single expiration. So and for example, when the skew is high now, it actually gives more value to OTM puts, and that's what we're going to see right now. I mean, not right now, but because I've got another. Sorry if it's when I talk, I sometimes go ahead of myself, but anyway, I'm going to try and follow this thread. So I said I talked about modeling. So modeling is basically trying to figure out how volatility looks time-wise and strike-wise, horizontally and and depth-wise or vertically. There are a few, and this is a very, very, very short summary of what you can read on the internet. And I will try and post on the Arima forum a few references for those who are mathematically inclined. So, but in a nutshell, there are deterministic local volatility models. So basically, if you see here, you look at sigma being a function of strike and time. So when you have a function of strike and time, and you can model that 3D surface, you just have for the right strike and the right expiration, you just have to calculate what the volatility would look like, and you plug it back into Black-Scholes. And then you can actually figure out what the price of an option should look like sometime in the future at a certain strike. And that's how the default surface generally works on most platforms. When you switch from, if I use the option view jargon, EIO-IO, each individual option on its own, which is basically, which is in TOS, it's called individual volatilities. And that is generally the best way to look at the T+0 now. I mean, the T+0 is the closest possible T+0. Doesn't need actually a volatility model. You look at what is going right now. So basically, you back into a 2D world. You don't actually project in the future. But if your software then projects a T plus N line, the individual volatility model will be wrong. I mean, it can look good, but it's definitely when you use individual volatilities, you basically use today's volatility and you project them as being constant over time, which is absolutely wrong. So when you use whatever platform, you know that you shouldn't actually display several lines if your individual volatility model. I mean, that doesn't make any sense. Only when you want to project, and as a matter of fact, a good platform should use the EIO-IO or individual volatilities for the T+0 and should switch back to vol surface for further projections. That would make a lot more sense. But for some reasons that are beyond my understanding, you usually switch as a setting on your platform from one graph to another, but they don't actually blend. Again, that doesn't make sense. So that's the simplest way, and I like things to be simple. This may sound a bit complicated, but really that's the simplest way to approach volatility model or volatility surface. Basically, you try and figure out what is volatility on a certain strike at a given time. You build a surface, and then you can bring it back to Black-Scholes, and for your own trades at certain strikes, you have a better idea of what volatility should be like certain time in the future, and you try and project. So your T plus N using model like that will be more accurate or correct. There are then more sophisticated models. And as a matter of fact, those more sophisticated models have also led to more sophisticated pricing models. So that's a family of stochastic volatility models. So for those who use technical analysis, this is a big misnomer. This word stochastic has absolutely nothing to do with the stochastic indicator you can find on any software, technical analysis software. Stochastic means a random variable. So basically, you assume that volatility itself will follow a function, a statistical function. We call it a random variable. And then you have volatility that can be then modeled according to three variables: the strike, the volatility now and the time. So it's actually or not volatility now, but the dynamics of volatility and time. So the dynamics of volatility, why shall we add a third variable? I mean, it looks like, again, like Black-Scholes, like it's a chicken and egg situation, and it is not. It's because volatility, and like the VIX, let's look at the VIX. The VIX does follow some patterns. It is mean reverting, like SPX is mean reverting. So generally, when you, for example, on the SPX, because that's the index I trade the most, when you are generally 2 SD from the mean, 2 standard deviations away from mean, there's larger chance that statistically there will be a return to the mean. Maybe I have a chart somewhere, but I could put one up. That's my, I was mentioning technical analysis. I do use a chart of mine with some proprietary indicators, but we could use, looks like it's not loading. We can use let's say use any software, and you plot the Bollinger Bands, for example. The Bollinger Bands are basically a moving average with the 1 SD and 2 SD bands around it. So that's when you know that when the price is going far away from the mean, it is likely that it will then revert to the mean at some point. I really don't know why my internet is so slow today. Can you hear me well? I hope so. So here an example. I mean, when you have an increased volatility, for example, here, I mean, but for example, here you have the mean reverting. It's going to 2 SD and it's reverting to the mean. Here it hit almost 2 SD, and it reverted to the mean. So that's what we call a stochastic behavior. So by using the dynamics of the volatility itself, you can try and figure out the three variable model, because then you have sigma itself is the function that can not be described deterministically, but it will follow a statistical function. And I can tell you, this is not an easy thing. Excuse me. So, and as I said, there are other models, more advanced, more specific. For example, I mentioned the jump diffusion model, because then the volatility model then has an impact on the pricing model. And in this particular example, we know that Black-Scholes does not work well when there are sudden, abrupt changes in prices. It's based on a geometric Brownian motion, and it's supposed to be a continuous function. So, for example, something that we should all know is that, for example, and you know, everybody tells you that you shouldn't trade in the first hour of the day, especially when there's a gap. It's also the reason why market makers have no idea about pricing when the market jumps all over the place, because they trust their tools based on Black-Scholes, and it doesn't need to be a rocket scientist to figure out that pricing goes all over the show, because Black-Scholes does not deal well with jumps. So there are models that deal a little bit better, but it's more like a quant stuff. So we're going to concentrate on the local volatility model. There are, when I started looking at, because it's a deterministic model, I would have thought, like, you know, you've got Black-Scholes, you can assume that, okay, there must be an equation. The equation can be turned into programming code, and plug in my strike and my time, and boom. And yes, I found that one. Sigma of KT, K is, or sometimes it's called X for the strike, and time. And here there's a little fancy equation, but uh, doesn't really matter. I mean, Q is the sometimes we call that cost of carry, but generally it's a dividend yield, or is the rate. So, I mean, a few partial derivatives, but nothing that complicated to compute. The thing is that I've only actually put one on this slide, and when I looked at several references, there's no consensus. This equal sign should be actually a more or less equal, because according to the different volatility models, and again, supposed to be deterministic, supposed to stick to Black-Scholes, there are still variations. I mean, okay, sometimes it's only marginal changes, but still there's no way really to figure out what is right and what is wrong. So, but let's say that you have an equation, and you choose the one that's according to the hypothesis described by whatever reference material you get. Okay, you can get a fairly good assessment of volatility. And there again, when I read all those references, and that's maybe why they put an equal sign here, is because they are quants, they are academics, they are very clever people who really go through all the contingencies, all the restrictions to the model. And I go back to what I said earlier. A big one is that your model must be arbitrage free. So I stopped it here saying with a bit of a headache. So it is theoretically strong, and there may be some differences from one model to the next, but they all look the same. I mean, but it's complicated, and also for me it's a bit of an overkill, because as I said, from a trader's or practitioner's approach, I don't really care about the market being arbitrage free, and sometimes they use what they call the calendar test and this and that. I don't really care. So I'm going to go a bit deeper into the deterministic volatility model, but after reading a lot, studying a lot, I found something that to me is the simplest way to approach that problem. And it may not be satisfactory for a lot of quants and academics, but I've seen it being used on a lot of occasions because of its simplicity. So what does it consist of? And it comes, here I put one reference. It comes from a research paper from Dumas, Fleming, and Whaley back in 1998. It has been improved a little bit since. I think there was an update in the early 2000s. And it's for me, it's a perfect tool for a non-quant practitioner. Okay, it's a bit of mathematics, it's a bit of computing and programming, but as you can see, it's just quadratic regression. So what does that mean? Is that you're going to go through the samples that I mentioned earlier. So basically, you sample different option prices, and hopefully not too many, because it's not necessary to actually record all the implied volatilities for all strikes, for all expirations up to the number of days you're looking at. But if you look for, you're going to use those numbers basically. So you're going to put in, for example, the sigma or volatility given by extraction of volatility through those data points, and you're going to apply them through one of those models. And of course, the model 0 is simple. It's basically a waste of time, but it's actually the original Black-Scholes, where we used to assume volatility would be constant. The model 1 is actually assuming that volatility only changes across strikes with no time effect. And then you actually start putting in the time effect. So and if you were to use a linear regression, it would be A0 plus A1x plus A2t. But You know, when you start doing regression, and if anyone who's done some statistical studies, university, you know, you have an idea of the shape. We know that the volatility is not linear. We would like to think, and as a matter of fact, yes, it is almost linear if you go very far out. I mean, 100 days, 150 days, yes, it's really linear. But a lot of us are trading 60 days or less. And we know that the vol shape looks almost like a parabola. So again, that quadratic regression does make sense because we are going to look for something that we know looks like real life. So what we can do, and what I advise to do, and that's what I'm doing actually in SOAP, and I do suspect, actually, I can't really confirm because again, we're talking about black boxes, but option view has changed from a 3-point model, where this used to say, to a 5-point model. And I would assume that they also use kind of a regression model based on 3 points on X and T to a 5-point model using the second degree. So basically we assume here, by using model 3, that the vol shape will more or less look like a complex 3D curve. And it's generally good enough. But in my own research, I actually found out that we can add more terms. And if, of course, if you make your model more complex, you need more points. So coming back to what I said earlier, it's always better to sample with a minimal number of points. But if you use, let's say, 5 to 10 points for each expiry, and not because there is, for example, on the SPX, you've got expiries 3 times a week. So, you know, on the time scale, you also have a lot of points. So basically, you sample, let's say, 5 to 10 points on an expiry across a number of expiries. And then if you have enough points, it should model pretty well. But this is not part of the conventional research, but that's my own finding. I would also add more products. So not only a parabola across one dimension and a parabola across the other dimension, and just one cross product. It can work, but we know we've had very odd shape in terms of volatility. Actually, I can show you. Where did I put it? I think it's here. This is the vol surface of XSP, which is the mini SPX. And I think I can turn it around and rotation. So that non-parametric regression may work, but it's not going to do a very great job. And as you can see, even IB, because it comes from IB, does not even sample it carefully. So it is roughly a parabola, and roughly, it's almost linear on time-wise, but it's not exactly it. So actually, one simple way of modeling the vol surface is actually to use the VIX term structure as one way of recalibrating a vertical. This is the vertical skew for each expiry. And you can actually recalibrate it by using one data point or 2 data points and using the VIX term structure. If we go to the VIX central, you will quickly see, for example, here the contango. So we are in contango. So you can then assume from this volatility surface, it's more or less a series of parabola just being displaced a little bit through a curve which is related to the VIX term structure. And to be, excuse me, when I talk too much. And to be exact, actually, on the VIX term, we should actually add more points for the but then you can see that you may have some abnormalities or aberrations here. So you have to be careful when you use all the weeklies and everything. And but that's a good thing about regressing it through a polynomial, is that those aberrations will, statistical aberration will generally disappear. So I hope you get the drift or the gist of what I'm trying to say by building the simplest possible volatility surface using a number of points and a model that looks about correct. That being said, this vol surface is in fact more complicated and less accurate, because I know that when we trade, we use strikes. We would like to see on this axis prices, and because this is the XSP, this is roughly 10 times lower than the SPX, but this is more or less the same. But as a matter of fact, statistically, we should use another dimension here called Moneyness. And Moneyness is generally the logarithm, natural logarithm of the underlying of the strike price, or vice versa. And when you do that, and it's a pity Gary's not here today, because he's done very interesting experimentations on that. When you change this axis, you see that those lines actually do have a lot more similar shape. And by having a better looking data set to start off with, the regression model you're going to be applying on it will work a lot better. But for some reason, even IB here, I don't know whether it's not to confuse people, but what I'm saying is that even if it looks good, it's almost useless. It's because of course, their point is they're not here to model. I mean, this is really IV. I mean, they have huge data banks, and it's very easy for them to extract IV from market prices. They are brokers, and they're not here to give us very complicated tools or sophisticated tools. So this is really what the market is giving us. But when you try and model, because then you want to plug it back into Black-Scholes, and for your own analysis, you want to know really whether you get a good projection, and a good projection comes from good data or in a good model. I would say that it's better to actually use here the Moneyness and not the strike price. And it's quite easy then to do the invert relation to get back into strike. But the modeling will work a lot better if you actually massage your data set a little bit. I hope I'm not losing you here. Oh, well, actually I finished, yeah. 45 minutes. Usually we go for about 30 minutes topic, and then we can discuss. So if you have any question, that's a good time. I see a chat. Can you give us an example on the subject on TOS calculation, and I correct the vols according to that? Well, I don't use TOS, but I know that TOS uses Bergström-Stensland. We're not even sure. I mean, I will have a session on American options and pricing. But I have no idea how they calculate vol surface. In that department, to me, it's like one or option U. To me, it's a black. I'm just quite open about what I think is the best and the simplest way to approach vol surface practitioners' point of view. Because again, if you place your data points correctly, and I mentioned that using Moneyness instead of strikes as an axis, and maybe Gary will be back next week, so we can actually expand on the topic, and he will have some thoughts, and because he's done a very good work on it. But then what I'm saying is that you start from, like IB is providing, you know, the vol surface from prices. but if you can actually portray it, display it in the simplest possible way, the regression model will work a lot better, a lot better. TOS uses individual implied volatilities. Not necessarily. They have both models, individual volatilities and vol surface. Not a question, but comment. Manually modeling is the first thing I tried doing in options. Now I'm understanding better why I failed. No. I mean, okay, many of you may not be as mathematically inclined, but this is still easy stuff. Really, if you want to have a real headache, go and read a few PhD theses. And again, I just want to make this clear. I mean, this is not rocket science. A non-parametric regression. I mean, a lot of you on Excel have done those linear regression, you know, the least square, or you can have a polynomial regression. All those things in 2D are simple. It's just a little bit more complicated because you're doing it in 3D according to two variables, the strikes or the underlying and time. So, and I'm not saying that it's ideal, but it's simple and it does a fair job. And if you really want to increase your level of accuracy, again, I would suggest switching from strike to Moneyness. I've got another tweak, but I will do that on another session because when I can show it on SOAP, it's going to be more visual. So Nikolai, I mean, where did you stop, and what really troubled you? I mean, again,
I wouldn't say what troubled me. I think I stopped at Black-Scholes calculation. I didn't dive too deep into it. I was trying to compare constantly with option view, but I knew that there had to be some other modeling, like binomial or modeling that you mentioned are used in option view. I knew nothing about it.
Binomial is, you know, when you go on options 101, they teach you about binomial because it looks more visual, but it's a bit of a pain in the neck. And it's the closed equation, at least you get the Greeks right away. They're also straightforward equations. When you do binomial, basically it's difficult to calculate those derivatives. So you basically calculate them by hand, you know, what was the value of that price versus the period before. And, you know, it's like a, how do you call it? Calculating the gradient of or the slope of a line. So it does work. It's a lot of beginners go through that, but I thought I'd skip it because it's not interesting. And if you want to have the same accuracy on a binomial, you have to go through huge loops. You know, you have to really do thousands of iterations to get something that looks good. But I mean, that's okay. I mean, it does work, and it's. I suppose if this was a course and not just a discussion on options mechanics, I would definitely have almost started with the binomial model, but I'm not interested. Model used by SPA market makers, they use Black-Scholes. I mean, this is how crazy it may look. I know academics use fancier models, as I said before, with volatility models, the stochastic models, which then turned into Heston model and all those things. But they use Black-Scholes. But you must also think that market makers, they have a duty to provide liquidity, but at the same time, they have huge portfolios. We're not talking about trading in RTT. We have 5 or 6 strikes and we're happy. No. They have huge portfolios across a lot of assets. So it's they have other tools. But in terms of volatility surface, I would say they don't really model it much, because it's more really dealing with the book, and of course I would say they use local volatility to really eliminate arbitrage, but they also trade the underlyings a lot, so it's another ball game. But in terms of options pricing model as such, there's still, I would say 90%, 95% worldwide still use Black-Scholes. And that's also why since day one, I've talked a lot about Black-Scholes. And I think it's an important thing to know. I mean, I mean, it's also good to play around with an Excel spreadsheet. Actually, I posted my Black-Scholes model on the last version I posted. I made a simplification, which actually is probably good enough, as I said earlier, on long dated options. And I know some traders, they don't really want to look into and deal with the dynamics of an option after 30 DTE, because it becomes a bit more complex. But if you trade an RTT, or at least the original RTT, when you used to enter 100 plus days to expiration and closing it 30 to 40 DTE, you place yourself in an area of the vol surface where the vertical skew, so we're talking about that across an option chain, is almost like a line. So and then according to the volatility given by the VIX, as an example, you know that when ATM volatility goes up, there's as I said, when you look at long dated options, and you can then assume that a linear regression would be good enough. So for those who trade longer dated options and particularly OTM options, like an RTT being placed somewhere bearish, further down, and that can also apply to other trades like the STT from Ron Patino, and there are people who really like trading long dated options and far OTM options, and there's probably a reason why, is that the skew is simpler to manage. It's almost a straight line. That said, I mean, when volatility goes a little bit berserk, you can, something that we can almost actually see from here, that is that, and that's also a reason why a 2D, sorry, a regression, quadratic regression, excuse me, may not be good enough, especially if you trade far OTM, and then you question yourself, well, what is my software doing? I mean, what type of vol surface are they using? Because if they don't model it properly, they may be just calculating something completely wrong. But there may be a problem in some environment, which is the concavity. So far, we've assumed that, okay, it's a kind of a parabola, and a 2D regression in both directions should be doing okay. But this is not necessarily true. Actually, if I've put on my demo account, because I'm testing my sub-program. Let's see, options for volatility, I think it's here. As you can see here, for the skew here, it looks like it's pretty straight. But I've got another, or is it here? No, this is the, I forgot where, maybe I put it somewhere else, I don't know. Options analytics. No. I've got a page somewhere, unless I deleted it, because I played around with it lately, so I'm a bit lost myself. That's not here. Anyway, But anyway, you can see here that sometimes you have some concavity that would make the model go wrong. So that's why if you want to, you know, your vol surface will behave better if you know for what it does, you know, how it does calculate, and whether your trading is adequate or appropriate for the modeling. All I can say is that the model is simplest if you are far dated and relatively far OTM. It's more complicated around the money, and let's not forget that the money is a very elusive thing because the prices can change rapidly. But also sometimes you have that concavity that messes up the calculation a bit. But I don't want to be too negative, and it's generally okay. But when you have a very odd vol environment, which you can, I don't know why I've lost it. I had I shouldn't have played it with this. I had something close to, well, anyway, I changed it. Yeah, I mean, when you can plot the vol surface properly and you see that concavity, you know that something is going wrong, and you don't know whether your software is dealing with it correctly. Yeah. Any other questions? What software are you all using? I mean, are you all on TOS only, or do you have any other software? If there's anything to remember is that implied volatilities, individual implied volatilities, is probably the best way for your T+0, and it's generally, well, not generally, it's always wrong when you start projecting. So don't bother about T+n. And vice versa. I mean, if you know, it could be a good indicator, because if your implied your vol surface calculations are correct, they should actually converge back to today to implied volatilities. So I'm not saying that because it doesn't, that the vol surface is wrong. Maybe the vol surface is correct for a certain level of projections in the future. But I would say in an ideal world, your vol surface calculations should converge with implied volatility when you get back to T+0. I hope I make myself clear enough. Or do you understand what I'm trying to say? Okay. Option view, I was quite disappointed. Option view, I was a very loyal customer of option view for many years, but the way the model handled ultra low volatility in 2017, to me it was shocking. And that's actually when I started thinking, okay, it's time to build my own. You know, probably a lot of practitioners and developers were taken aback. I mean, who would have believed that the VIX could hit a 25-year low? I mean, I think the VIX only came to existence 25 years ago. So, you know, it's an imperfect world. But if you understand, if you start plotting IV, and when you do your homework, meaning that you take screenshots and you go back to your screenshots a week before, 2 weeks before, and you say, well, you know, in this vol environment, my software did pretty good, or it doesn't, or it went completely off, you know. Well, that's that. So it can be visual, it can be simple in a way of, you know, checking, but I would say that's why I always end my presentations by keep thinking, is that don't take anything for granted. That's what I'm saying. Okay, I've spoken a lot, but it's almost an hour. So if you have no more questions, I'll see you guys in 2 weeks' time. But I've got a few more minutes if you have any questions. You can always send me questions on bruno@aeromere.com. And there's the forum on for this trading group, or whatever it's called, options mechanics. Okay, thank you guys, and hope to see you again next in 2 weeks' time. Bye for now.